Welcome back to Benzinga's Pre-Market Prep. I'm Spencer Israel along with Joe Elconin, and we are on with Michael Corcelli of Alexander Alternative Capital. Michael, I just want to jump right in. Real quick, we just got our jobs report. Do you have any reaction to that?
The jobs numbers came in really positive this morning, in line with consensus. Another strong report. Yesterday there was some numbers out on unit cost labor, and we've seen a strong gain. So we're starting to see some wage inflation creep into the numbers, which is a positive thing.
So then, I guess, are we locked in now to the Fed raising rates? Is that a foregone conclusion?
From my perspective, they're definitely going to move in the next meeting in 10 days.
All right. We are seeing major volatility in oil this morning, coming off of OPEC. Well, what are you seeing in oil?
Oil is clearly a supply issue, and it's something that we've been very focused on this year. It was, clear to us that storage is running low, specifically in the U.S. And the production of oil, even after CapEx was cut about 18 months ago, was continuing to run up. Then you had other factors like the Iranian nuclear deal, and removing some of the sanctions that were placed on them and bringing them into the production, the global oil production again. And clearly today we're seeing we're seeing the effects of that, the impacts of that. I see $10 off of a barrel of crude. A lot of these E&P names are going to get crushed. The really, really high quality ones that are going to survive will provide really good opportunities here. But this is definitely a supply issue with crude oil, and I don't see it getting better anytime soon. 2016 should set the floor. And then we can look forward, to improvements. But they clearly have to clear the decks. They started it 18 months ago. It's a process. It's not very quick, and we're at the early part of it, unfortunately, for people that are long oil companies.
So if it's a supply issue and the Middle East suppliers aren't cutting their supply, how does this get better for the U.S. suppliers, U.S. companies?
Yeah, absolutely. So we know that OPEC's meeting right now. There was an internal document prepared for this week's meeting. There's a note out of Wall Street Journal this morning that warns oil prices staying depressed in the near term due to oversupply conditions. Both Saudi Arabia and Iran are basically telegraphing that they're not going to cut production. So if they're not going to cut production, you're going to have a continued slide in oil prices. That coupled with the Fed rate increase, strengthening dollar, will continue to undermine the price of all commodities, especially crude oil. Now, in the U.S., we have been more fast to respond. We're quicker to respond to macroeconomic events. When the price of oil started to slide, investors started to walk away from E&P, new exploration and production, even before the price of crude last June started to fall. I noticed, in the deal calendar, that a lot of these MLPs, a lot of the people that were doing exploration production, they weren't raising the money that they were wanting to raise, and they definitely weren't raising it at the prices they were expecting. So in the U.S., we were ahead of the curve in cutting back our production. So we just haven't been reinvesting in new rigs. We cut the rigs. Baker Hughes has been declining since then. And, so in the U.S., the production should start to slow and perhaps even go negative. There is a completion phase where they have to complete the wells, the projects that they started. So you're going to see in the U.S. next year the production start to slide. I haven't even talked about the, there's a lot of wells that cost a ton of money at $50 crude. We're at, $40 right now. So they're losing $10 a barrel. There's about 1 million barrels of production per day that are going to come off as a result of low oil prices. So the U.S. price situation should be supportive. China is slowing. So from a demand perspective, China is a major story that you need to focus on with the price of oil. Their demand is slowing. The Chinese economy is going through, a complete rebalancing. The manufacturing sector is, contracting. The non-manufacturing sector is doing okay, so we're expecting less growth coming out of China. The big story right now is definitely a revenue story. If you look at the earnings that just recently had come out, you're going to see that, like I always put a picture whenever I write something about revenue, and it's the old Wendy's commercial. Where's the beef? There's no revenue growth. Where's GDP growth? Where is it coming from? So if you guys look at the last 3 times I've been on your show, you'll hear me talk about, hey, we need to stay optimistic here. Things are not that bad. There's going to be some volatility, but the big picture is still, there's still growth. I feel like I'm getting tapped out with that story because I keep waiting for sales, for revenue growth, and most of the companies are disappointing on that basis. We were just talking about oil. Oil's been cut significantly. People are saving a ton of money at the pump. That money is supposed to go back into things like retail. The consumers in the U.S. are supposed to consume. There's a lot of consumers around the world. There's actually 5 billion people that benefit from lower energy prices versus 1 billion people that benefit from higher oil prices. So we're still waiting and looking, and people just don't trust the economy at this stage. They don't feel like the wages have kept up with the inflation and the cost of goods, and so they're not spending. They're actually saving the extra money that they're saving at the pump, which is not a good thing, and I need that story to crack. I don't know. I'm not smart enough to figure out exactly how it's going to crack or what's going to cause it to crack, but the longer this persists, the more concerned I become with global GDP, the more concerned I become with equity valuations priced to almost perfection. And, perhaps the next time you have me on your show, I might turn into a perma bear again. So that's where I'm at today, guys, on the global economy.
We're on the line with Michael Corcelli and discussing the market of Alexander Alternative Capital. Michael, I just want to throw one thing out there. We could talk about oil. We could talk about, the markets and interest rates and everything. But, it's maybe kind of old conventional wisdom is that, it's really tough for the market in a rising rate environment. We are embarking, at least, everything is set up for that. Is that any kind of a warning flag, or do you have any statistical studies where after there is an interest rate hike, the market still, goes up for an X period of time? What's your thought on that?
Joel, I just recently spoke on a panel with some people from, for instance, BlackRock, RWC, very, very smart people. And, one of the questions that was asked from a long-short equity hedge fund out of New York that's a very successful fund, and the guy asked a very good question. He says, are we getting it wrong again? Is this 2007 where just everything is telegraphed that, there's going to be a tremendous amount of volatility going forward, and these markets are going to get, they're going to get cut. They're going to be pretty much, cut by 30-40%, and everybody on the panel just sort of looked at one another, and we didn't have an answer for it because it is a difficult time. We are in front of getting off of 0% interest rates. That's done. The easy money is done, and the economy has to start pulling its own weight again. Now, some people are starting to say that, well, in this new normal, reducing taper and quantitative easing, that's the real, that's the real tightening of Fed policy, is going from doing, $60 billion of bond buying a month to 40 to 30 to 20 to 10 to 0, and then telegraphing a rate hike. So what people are starting to say is that we've already done the tightening that this economy can afford, and we're not going to be able to do tightening like, a 0.25% interest rate for the next 2 years, like, Alan Greenspan had done a couple of times in his career. Those days are gone. Now, if you talk to real estate people, which I have. I'm in South Florida, so there's a lot of real estate developers down here. There's a lot of people involved in the real estate markets. I'm friends with a lot of people inside of these commercial real estate companies. And my friends said that there's a monster push. There's people working, 20 hours a day, and those people are working on locking in rates. They're scared of what's going to happen, what's going to come. And again, there's we're finally at the inflection point for inflation. So hopefully we don't have too many interest rate increases coming. Hopefully we do 25 basis points in the next couple of weeks, and then for 6 months we keep it at that. But if inflation starts to rear its ugly head, the Fed has to get out in front of it and actually cut it off. So.
And on the other hand, if they do the bump up and then we start to get some bad numbers, then it's on the growth sector, if things don't pick up, then it's just the Fed's going to be in between a rock and a hard place. So a couple different scenarios. We've been on the line with Michael Corcelli. He's from Alexander Alternative Capital, giving us a balanced perspective on the markets. Michael, we appreciate it. We'll talk to you again soon.
All right, Joel. Thank you. Have a great day, guys. Thanks for having me on.